Hey guys, today we're going to jump into a little bit of macroeconomic analysis, just kind of recap the week, recap the year end here, and then we're going to dive into our precious metals and our mining stocks. So first comes first, ever since the rate cut of last week, obviously you have your short-term treasury bond yields that have gone down in the crypto market, right? Crypto has been notorious this year for being highly correlated when the NASDAQ moves up, but absolutely discorrelated with anything else, right? Because ultimately, when crypto moves down, it doesn't mean that the NASDAQ's going down, right? So you have correlation one way, but you have discorrelation the other. A lot of the crypto crowd have been banging their chests trying to explain why their digital asset isn't doing very much and isn't working the way that they feel it should work based on historical evidence. Right. Historical being that there's only like 5 years of data since that this has been a mature asset. Precious metals. We just had an absolute killer start to the month in the silver. Gold is retesting its current all-time highs. Very interesting, right? Obviously, a lot of volatility. We want to make sure that we're not doing anything rash, especially if you're investing in the precious metals, more specifically in the mining sector. If you're not careful, if you're not diligent with your analysis, if you're not stress testing your valuations, I would highly recommend that you revisit your portfolio and actually understand what the base case is and make sensitivity tables on your investment, right? For example, if you own Newmont, if you own Barrick, if you own Agnico Eagle, ask yourself, if gold were to pull back 25%, which is historically very normal, what happens to the valuation of my investment? Do I feel like it's still undervalued? Do I feel like it's fairly valued with that sensitivity? Or do I feel like it's overvalued at that point? And knowing this, knowing what might be a smart thing to act on is extremely important. And I've seen many individuals in this space who know a lot about this space, who don't have those parameters in their investment thesis. It should be embedded. It should be at the core of what we're doing on the upside and on the downside. So really important here, guys. In terms of foreign markets, you guys might be wondering, why is foreign markets on here? Who really cares? Well, the who really cares is exactly why I have added this here, right? On the left-hand side, we have Chile's equivalent to like an S&P 500. And on the right-hand side, we have Brazil's ETF. And I want us to look at the performance on the year, right? Chile up over 52% on the year. Its market has a 14 PE ratio and a dividend yield of 2%. And Brazil has a PE ratio of 10 with a nearly 5% dividend yield, up 37% on the year. And I want us to contrast that with the S&P 500, which has a sub 1% dividend, which has nearly 15% return on the year, and a near 28 price to earnings ratio, right? The reason this is important is because we have to ask ourselves as investors, where are we associating geopolitical risk and premium? And then to what extent does this factor into my valuation, right? For example, if I said we have the exact same asset, one of them is in the middle of Brazil and the other one is in the US, all else is equal. Somebody might say, well, you know what? I'm willing to pay 50% more for that asset if it's in the US because I feel like I'll get more fair treatment. I feel like I have more economic predictability. I feel like the currency risk is less of a threat. All right, fair enough. The question becomes, what if the arbitrage is now nearly 200%, not 50%? I'm not one to say that that premium is definitely not justified. I am one to ask myself and to ask other investors around me, have we even made the mental models? Do we even know what we're comfortable with? Or is this more of like a passive flow of capital in a market because we're just used to it? Not because we're being diligent, not because we're being thoughtful, properly analyzing the pros and cons of jurisdictional risk, but just because this is what we've done and this is what we've always done. And this is my concern here, right? Especially for companies that might be a little bit more brick and mortar. For example, you have the equivalency of like a dollar store, a Walmart, a Costco, right? You're buying a potato, you're selling a potato. Right? If you're telling me I can get the potato arbitrage company in Brazil for 3 times less expensive than I can get it in the US, I think it's at least reasonable to assume there should be more people looking at that market. And clearly this year there has been, right? That's why we have these over performances. But I would like to bring the attention here. And if we look at historic precedent and you have much smarter and wiser people who've been around the block a longer period of time here, who've been kind of screaming at the rooftops right now, saying that in nearly all historical instances where we've seen an overperformance in the developing countries against the Western world and primarily the US, This has never been just a 1 year trend. These tend to happen over several years, leading to a re-rating of the jurisdictional risk, allowing the market to figure out what these businesses are actually worth in these areas using our analogs of the Western world, right? Because we know what we're willing to pay here based on the risk profile here. So it's just about price discovery right now, figuring out, well, what are investors willing to pay if they open their eyes over here? Next thing I want to dive into, I want to do a quick touch up on the crypto market. And I'm going to start out with going over a short clip. And this is at the recent crypto conference in Dubai, where Peter Schiff is given gold by CZ. And here I'll play for the following.
Yes, yeah, it's heavy. Is it real gold or no? Well, I don't know. I mean,
Is it real gold?
Is this what you're trying to? I mean,
now I was very disappointed with Peter Schiff's response here. Basically, he fell into CZ's frame and he tried to argue his way out of it in a way that was very, very pointless. And Peter Schiff, if you're ever listening, if I ever get the privilege here, this is no disrespect to your work, to everything you do. But that being said, I think here he focused on the wrong thing. What should have been said is just because that there may or may not be a counterfeit of something doesn't actually inherently hurt its value, right? For example, if I gave you a pirated iPhone right now and it looked like as you logged into an app, you have 3 Bitcoin, but it's actually not there, and I've just programmed it to look that way. Well, it doesn't make Bitcoin unvaluable. That's not the argument that makes Bitcoin non-valuable. There's 50 of them, but that's not the one, right? Or if the deed to my house gets copied and there's a forgery next to me and I can't tell which is which, does it mean the deed of the house has no value? No. If anything, the fact that there are forgeries of it actually might be an indication that there is value, because there's enough value for people to be making the fake representation of it. And we have ways to test the metals. There are machines that we can do. There's drill tests that we can do. So ultimately, this argument was just a non-starter. It was good for a clip. And then the crypto people ran with it and they made this sound like it was a huge gotcha moment. Like, oh, the gold bug can't tell what gold is. Well, it doesn't matter. It genuinely doesn't matter. Oh, I can't tell which is the right deed to my house. I still need a deed to my house. It's still valuable. Unfortunately, there's no argument there. So I just thought it was really weak, but it rattled up the crowd. And I think Peter Schiff didn't properly shut down the argument, which could have been handled very, very, very differently. That being said, next thing I want to bring up to crypto, which I've been waiting for a name, like whether it's Peter Schiff or another person to be bringing this up. Lynette Zhang does bring this topic up, which is one of the few people who's kind of willing to extend the argument all the way, right? Like people criticize crypto in all kinds of different ways, but I feel like oftentimes it's done in a fairly weak manner. The quote that we've seen across the world pretty much is this idea that by 2030, you will own nothing and be happy. I actually don't believe that this quote really implies anything malicious. I think this is just watching behavior and seeing how things are. We have software service, more people are renting things than owning things. And the person who said it was a lot more just inclined to notice patterns and then predict than it was a bad actor that's trying to lead you into a direction. But my issue with this is specifically because the sound money people have been bringing this quote up a lot. And the gold bugs, they've been prescribing to this problem, buying real assets, gold, land, silver, add to the list. The crypto people will look at you straight in the face and they'll say, by 2030, you'll own nothing and be happy. We need to do something about this. So let's sell all our real assets and buy a digital fractional open ledger version of nothing. And then I just look at them a little bit and I actually pause because it's hard for me to understand what's going on in their brain. Man, you got two brain cells and they're both fighting for third place. Please, somebody come save these people. Somebody come bring them back to sanity because they need God. They need Jesus Christ in their lives. And I just hope that we don't get like the extent of a 2008 situation where it basically obliterated a whole generation's wealth in order for them to change their investment behavior. I don't want that to happen to our generation. I don't. But right now, I don't see any other way we get out of this terrible management of capital allocation. Now, the question becomes in the crypto space, who is the exit liquidity, right? Because you see these crypto ETFs that are owned by many institutions now and retail investors. You have the average Joe who owns his crypto. You have the crypto whales who've been kind of slowly selling into the highs. Who owns the bag when nobody else wants it? Now, in the last 2 years, we've seen a massive push to the retail crowd and to pensioners of private equity, of private credit. And now we're seeing crypto. Now, as a general rule, it's almost a joke on Wall Street. And this is actually bad acting. We say that when something starts getting pushed to the pensioners, you know it's time to get out. Those are the people that get exploited. And in crypto, you're getting hit from two sides because you have pensions that are going to slowly kind of ramp in here. But beyond that, you're getting pushes from a lot of these players to get our governments involved, our central banks involved. And that to me is really concerning because really what that says, especially in an environment like we are now where we have deficits, you're basically taking on debt to subsidize an asset that somebody else owns and can sell into the rising volume. So we're basically saying that we're comfortable with the government holding the bag, but the government doesn't actually have the money needed to purchase it. So it has to take on debt with interest. So really what we're saying is the taxpayer in the future needs to carry the burden of subsidizing your crypto purchases so you can get out at a higher price. I'm getting to a point where I view this as nearly criminal. I'm not there yet, but I'm pretty damn close. This is nearly criminal behavior. And it's getting very frustrating to me because I'm seeing people left, right, and center push for this while simultaneously criticizing government spending, criticizing government overreach. If this isn't exactly what you're talking about, your opinion is worth nothing to me. You are engaging in double speak to the point where it's just not even fruitful to have a conversation with you. And it's just very frustrating. And lastly, on this topic, we have Michael Saylor, who in recent podcasts have basically given us the playbook, which was obvious. I've been talking about this. Several voices have been talking about this. But again, this isn't arguments that are being disputed. It's basically just you're throwing a truth out there, and the other side of the argument are just throwing it into the abyss. They're sticking their head in the sand and they're saying, you don't understand this. They won't actually engage with the idea. They won't engage with the argument. They will just shoot it back to you. Why is it important? Well, Saylor basically said if Bitcoin were to go to like $1, he'd buy the whole thing. Well, my issue here, and I explain this to friends of mine, and I use other things than Bitcoin because it tends to just be a lot more clear, right? So let's use bananas for this specific example. Right? Let's say I want to squeeze the price of bananas because I think I can make a lot of money doing it. Well, first thing I would do, right, is I would concentrate all the bananas. Now, if I wanted to be really like Bitcoin, I would then burn all the banana farms. So let's assume I have all the bananas, I burned all the banana farms, and now I need to establish what my banana holdings are worth. When I go to the bank right now and I ask for a loan, the bank is going to say, okay, well, bananas we're selling at around 50 cents. So we're going to give you a loan based on your collateral, which is 50 cents per banana. Amazing. Well, now what I'm going to do, because I have all the bananas, and I can go into a pool of 8 billion people to find buyers. 8 billion, right? And I have all the bananas. And I can put one banana for sale, just one. Say highest bidder. Now, you and I both know if there's just one banana for sale, somebody somewhere in this world will spend $100 for a banana, maybe $500 for a banana, right? And now what happens when that transaction takes place? What happens is I now have every other banana, and the most recent transaction is at $500 and price is set at the margin. So now the price of bananas is $500. When you search it up on Google, what's going to happen? It's $500. Now I go to a bank and I say, hey, my collateral is $500 per banana now. See? Then I get a loan for that money. Now I go back to you who still has that one banana. And I'm like, hey, buddy, I just got all this money because I got a loan. Let me offer you $5,000 for that banana. Now, you're looking at me like I'm crazy, right? You're saying, oh, why the hell would you give me 5,000 bucks for the banana? I just paid you 500 and you have all the bananas. Are you a moron? No, 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 no. Price is set at the margin. Remember the play here. As soon as that transaction hits and I spend $5,000 on your banana, I get to revalue my collateral based on the new price that was just set at margin, which is now $5,000. My collateral is just 10x and I have all the bananas. Guys, this isn't normal. This is absolute corruption like behavior between your institutions, your ETF treasury strategies, and at this point, they're lobbying government, so some players in government. This is really destructive for the financial systems. If anything, I would like to compare it to like a black hole. They're basically trying to suck in as much of the productive capital into this non-productive nothing. It is really, really, really in bad faith. Now, I'm not going to spend too much time on the bond markets, but what we're seeing, we obviously cut the interest rate, right? 25 basis points. And we also kind of set guidance for 2026, saying that we were more than likely going to be bringing down interest rates at least another time. As a general rule, I tend to say that I can trust them to do what they say or worse. Very rarely going to be better, right? So I'm expecting one interest rate cut, possibly more. And we started liquidity management. The Federal Reserve is buying short-term treasury bonds. Now, the question still is out there, which is what happens with the long-dated bonds that nobody really wants to buy right now. And the interest rate on those long-dated bonds haven't come down. Right, so that's going to be, I think, the 2026 conundrum. Like the central bank is going to have to figure out, like, what do we do with these long dated bonds that nobody wants? And I think the liquidity management, quote unquote, QE is going to have to shift its attention from the short dated to the long dated bonds. Now, what investors and central banks are doing, we're seeing around the world collectively, whether it's just bringing awareness or changing their treasury asset allocations. Countries, sovereign wealth funds, big money and institutions are all reviewing how they have diversified their portfolio. And a big component that is really under the microscope right now is the Western, and dare I say, the American exposure, especially in the long dated bonds. The reason I specify the long dated bonds is because I think we've done a disservice to the average investor looking at bonds and just throwing them all in one category, right? Because a short dated and a long dated bond are very different, carry very different risks. A short dated bond is basically just cash that gives you a yield, predictable. If ever there's high inflation, it doesn't matter because your bond is maturing within 3, 6, 9, 12 months. It's almost a non-starter here. You're just putting yourself in a position where you want short-term liquidity. The long-dated bond is a very different beast that carries a huge amount of risk in an environment where things are unpredictable, where you have geopolitical risk, currency risk. You don't know where the interest rates are going to be. You don't know what the CPI is going to be and how much it understates the actual true inflation. And then that gets even worse when you have these inflation-adjusted bonds, especially when the government's meddling and understating real inflation. So those long dated bonds are completely different in nature. And those are the ones that most of the smart money around the world are really putting back into question. When it comes to precious metals, we have the gold and we have the gold miners chart right over here. Now, I'd like to draw your attention. We went over this a little bit last week, but we can see we have our gold basically entering its near all-time highs. We've been touching like 4,350, which is around $30 away from the all-time high. And the GDX is basically creeping up to all-time high. So the miners are overperforming by a tiny amount the gold price. I think this overperformance should actually be expanded a little bit, but I think it's gonna take time, right? But silver is still acting very, very strangely. Like, let's look at this together. Silver basically closed today at $66, record close. Look how much higher we are from 54. We're talking $12 higher. And the silver miners are just basically at their all-time highs. A lot of these names aren't even at their all-time highs on the year. This divergence is incredibly shocking to me, right? More so than in gold. I would actually expect this divergence in gold, and here is why. We started the year at around $3,000 realized gold on the first quarter, right? Just under. Why is this important? Well, it's important because the average gold miner at $3,000 gold was already making at least $1,000 in margin. So really the story of this year, and we're not yet in Q4, but has been, for the majors at least, doubling their margin, right? So over the last 3, 4 quarters, we're seeing margins go from 1,000 to around 2,000. Now, yes, you have some high cost producers who had terrible margins and they maybe tripled, quadrupled, 5x their margin. But I'm talking about the majors here, right? With silver, what's different is in Q1, the average cost for these producers is around $25, some 30, some even higher than 30. So your margin was damn near $5, $3. And now I want us to actually revisit what just happened here, which is in the last quarter, we went up by at least $11. It's looking like Q4 might actually have realized silver prices of like 53, 54, maybe $55. If we were making $5 in profit at the start of this year for every ounce of silver, we just gained $15 of margin in 1 quarter, as opposed to what just happened in gold, which is the margin at the start of the year was already around $1,000, and it's looking like we're going to gain 500. Right, so it's looking like we're going to gain 50% of the margin we had at the start of the year, whereas for silver, it's looking like we're gaining 300% of the margin we had at the start of the year. The logical conclusion to make, if one of the mining sectors, either gold or silver, should be significantly outperforming the metal, it should be silver. It shouldn't be gold because of the margin expansion that's happening. There's greater margin expansion on the silver side. So ask yourself, why are we seeing such a big lag in silver? Because like I said, if anything, it should be in the gold space. So guys, I am extremely, extremely bullish on silver. Doesn't mean there can't be short-term volatility to the downside, right? If silver was to crash 10% tomorrow to $60, these companies are still way too cheap. But it doesn't matter because the market lets the macro of the metal dictate where it's going to bring its producers. People get scared out of these positions, right? That volatility tends to scare a lot of, especially the retail crowd. But these are the dynamics that I'm looking at moving into the end of this year. That underperformance in the silver mining space, where we're seeing the highest margin expansion we've ever really witnessed, or at least in recent history. This is where I'm looking at early 2026, right? When these earnings come out and show blow off quarter after blow off quarter, that re-rating potential can be phenomenal. Last thing I want to go over is the value proposition right now between majors and between medium-sized gold and silver producers, right? Because a lot of people right now who are maybe new to the space are currently looking at the names that pop up when they just search gold mining, silver mining, which tends to be the bigger names. And I don't think it's necessarily wrong to be putting money in those big names, especially if you're seeking less volatility. However, I have a small caveat to that. And I've been hearing mostly the opposite from a lot of the big and smart money in the space with valid reasons, right? They have historical experience dealing with these boom bust cycles in the mining sector. So I cannot speak from that perspective, right? I can just speak from an investor today that's looking at the alpha or upside as compared to the downside based on what I would consider to be like sensitivity models I have for gold and silver prices. Now, what do I mean by that? If I were to look at a company like Newmont, so Newmont right now, it posts as a 15P ratio, but if we do a forward P ratio, so we project it on current gold prices, we're basically looking at a P ratio of near 10. Very cheap historically for a company like this, especially with margins as healthy as we're seeing right now, incredibly strong cash flow. So what I like to do is figure out, well, based on sensitivity to the gold price, how far down can gold go for this to remain undervalued? If I give gold a haircut of around 25%, gold would go to around 3,000, low 3,000s. My issue here is Newmont actually doesn't really show to be very undervalued at $3,000 gold. Now, I wouldn't call it overvalued either, but I would look at a company like Newmont and say it is fairly valued at $3,000 gold, still quite profitable, still good free cash flow, but I wouldn't expect much upside. Now, let's flip it. If gold were to double from here, how would Newmont perform? Well, Newmont's margin would be absolutely incredible. It would do very well. We'd go from having around a $2,500 gold margin to around a $6,000 or $5,000 gold margin. So we double our margins from here. we could easily double stock price, probably triple, because I basically ultimately think Newmont is 50% to 100% undervalued at current gold prices if we sustain from here. So I think if gold were to double, Newmont could double twice, possibly, as like the most optimistic case, but really I would say could probably triple, right? Now, what we've said is it can triple if gold were to double, but if gold were to get cut 25%, it's basically fairly valid. Okay. Now, let's take smaller producers, right? And I think that's important to do. I'm not going to go super, super wild and go into jurisdictions that are very foreign to people, but we were talking about Brazil earlier. So let's look at Jaguar Mine. Well, next year, they're projecting to do around 80,000 ounces. They have high costs, right? Near $2,000 all-in sustaining costs. But whether gold is 4,000 or 3,000, you're dealing with a healthy margin. You're not stretched to start counting pennies, counting dollars. You have enough of a margin there where you're not worried that you won't be able to pay the bills. So what's interesting to me is a company like this, if gold were to double, the multiples on a valuation basis that a company like this would face are a lot more significant. So gold goes up, this performs better than Newmont, all else being equal, right? So they execute, they do everything they got to do. Their production profile and guidance are met, and things go smoothly. Like we're assuming that things go well in both cases for Newmont and for them. So if gold does well, they do more well. So there's more elasticity for a company like them to the gold price. Now the question becomes, let's run our stress test. If gold were to drop 25%, is this company overvalued, fairly valued, or undervalued? And what I'm seeing right now in the gold space is that when I do the stress test and push gold down, I'm seeing a lot of these small cap companies are still undervalued after stress testing for the gold sensitivity. So it's a really hard thing right now because I'd like to be able to buy the highest quality names. But what this little experiment we've just done kind of shows me is if gold goes higher, the high quality names have less performance. And if gold goes lower, the highest quality names have less upside because ultimately they're going to just grow into their valuation. Now, what really happens is if gold goes dramatically lower, closer to like that $2,000 mark, then the ones that go down the least are going to be the majors. They're still going to get clobbered. We're looking at like 50, 60, 70, 80% drops in some cases. Maybe the majors closer to 50 or 60%. But in those cases, that and only then I would really look at things on a valuation basis, right? A discounted cash flow model and say the majors are a better opportunity. But a 25% drawdown in gold, they're not, right? So this is where it gets hard. I do own Newmont. I own Barrick. I own the Canadian equivalency of the GDX, which has a lot of these majors. I would have liked to have owned Agnico. I just didn't see through comparative analysis enough enticement from the price point for me to justify allocating a significant part of my portfolio there. But yeah, all this to say right now, like the near term early stage producers, medium cap producers are extremely interesting on the gold side and even more interesting on the silver side, right? Only issue with silver is they don't have that much margin. They're only really getting a lot of margin starting this quarter. Like last quarter, some of them still weren't profitable. So we still need to grow into the same risk reward model on the silver side, because I would say still today that the large cap silver names like Pan American Silver are actually very attractive as opposed to the small caps on a risk reward basis, just because you are mitigating a huge amount of your downside risk if silver does retrace on a valuation basis, guys. Again, remember, I'm not just talking about stock prices. The stock price can drop 50% if we do a DCF valuation and the company is still worth twice as much. That is value. That is not price. We need to disconnect the two. With that being said, I'm going to leave it at that. I expect in the next couple of days, I will be sharing a conversation I had with Travis, who is a macro analyst and trader in the gold markets and precious metals. He's also a gold bug like myself. So expect a great conversation there. We go through all kinds of different topics. And yeah, thank you all for tuning in, and I wish you all the best.